So our next speaker is Richard Oldfield. Let's see if we can. Using the PowerPoint. Thank you. It's fast.
Well, I love this type of conference. I find it very relaxing. It's like going to a literary festival and very refreshing to hear about all the companies. And it's very rare in a meeting of 50 or so investors not to hear the words Trump in the last year or two and not to hear the words Iran in the last 3 weeks. I'm going to speak much more generally. And you may hate it, but don't worry, lunchtime is not far away. I liked the quote, the cartoon in Chris's presentation, that the plant got destroyed, but for one beautiful moment we created a lot of value for shareholders. Sorry, not the plant, the planet. So I'm going to talk a little bit more about what you might call planet-type things. It's a polite myth that investors, particularly value investors, don't care about the macro picture. Every investor I know does, of course, care about what's going on in the world and has to care because it affects what we do. But we also all know that forecasting is hopeless, which is why we maintain the idea that we look at companies and ignore the macro. I like to tell the story of the economist Kenneth Arrow, who won the Nobel Prize, who in the Second World War was asked to, he was a meteorologist in the US Air Force, and he was asked to do medium and long-term weather forecasts. And he quickly realized that these forecasts were hopeless. They were no more than randomly right. And he asked to be relieved of his responsibilities. And the reply came back from the commanding general. The commanding general is well aware that your forecasts are no good. They are essential for planning purposes. And I think that all of us, for planning purposes, have to have an idea about what's going on in the world. Macro influences, macro probabilities. So we can't ignore what is happening in the Gulf right now. I began my monthly newsletter in February, what can possibly go wrong, because things have been so good in markets and so good for the sort of thing that we do especially. It looked as though markets were vulnerable to triggers, serious or non-serious, to have a stumble. And as it happens, the trigger has been very serious. We've had a minor correction in the overall level of markets, but quite a severe correction in some value stocks. I was struck by the front page article in the FT on Monday, which in the first paragraph talked about the spiraling Middle East conflict. And I wondered, is it spiraling? It certainly has spiraled, but could it actually be at the top of the spiral? There's no doubt that it has escalated, but is it going to continue to escalate? Maybe it stays at the top for some time. Maybe it begins to reverse. It's interesting that Italy and France are in negotiation with Iran for safe passage of oil out of the Gulf. It's interesting that India has had this special dispensation. But we can't forecast whether the supply of oil goes on being interrupted for weeks or months or years. And I think it's important anyway to distinguish between military crises and economic crisis, and for that matter, market crisis, which is another matter entirely, because markets are so good at anticipating and may have already assumed escalation. We can only try to work out the probabilities and diversify portfolios so that they cater for a number of different probabilities. The war in the Gulf has resulted in a search for safe havens. And safe haven used to be rather a vague phrase, which meant reserve currency, and it meant the largest economy in the world, and these things pointed towards the US. It now means something really quite precise, which is a place least likely to be bombed, and that again points to the US. So in the last 3 weeks, there's been a reversal of the trend of the last year. We have felt ever since April the 8th last year that what Giscard d'Estaing called exorbitant privilege of the US dollar and US exceptionalism have been undermined by US policy volatility. The outcomes of all the tariff tergiversations might be good or bad, but no one could argue about the volatility of policy and the arbitrariness of government, arbitrary both in the sense of doing away with the established way of doing things and also arbitrary in the sense of flip-flopping of policy. And the war and the search for safe havens has interrupted that trend. But I think it is just an interruption because, in fact, US exceptionalism is being undermined again. Of course, the US is exceptional in technological leadership, speed of policy making, and its power. Only the US could do what it did in Venezuela and what has just been done in Iran. But the US role as leader of the free world has been undermined because leading is only a term which makes sense if others follow and others are not following. And the old world order has been shattered. So I think one of the themes of the last 12 months is likely to reassert itself, and that is that investors overloaded with US stocks, which after all are 70% of the world indices, begin to wonder if they should scratch around elsewhere. And when they do scratch around elsewhere, they find that looking for a bit of something else, they find that there are companies which are essentially sound on very moderate valuations. And the reason for this scratching around elsewhere, of course, is the expensiveness of the US market. I know you're all well acquainted with this kind of chart and probably with this chart itself, but it seems to me to carry so much weight that it needs to be emphasized. What it shows is the Shiller PE ratio at points, I think quarterly, all the way back to 1881 on the x-axis. And on the y-axis is the return over the next 10 years from that point. And as you see, most of the points are in a great morass from which it's impossible to draw any conclusion. With a Shiller PE of 20, you're just as likely to get a return of 15% per annum over the next 10 years as you are to get a return of 0 in real terms. These are all in real terms. But the eloquence of this chart is on the right-hand side. The blue dotted line shows the current PE, Shiller PE, which is around 40. And what this chart shows is that never, when the PE has been as high as this, is the real return over the next 10 years of US equities positive. On every single occasion, when the Shiller PE has been higher than 37, the real return over the next 10 years has been a minus number, not just on average, but on every single occasion. And I think that has to be recognized as the overwhelming probability for what happens over the next 10 years. This chart shows, it's rather badly labeled. It doesn't really show S&P 500 concentration. What it shows is the number of stocks on the right-hand side, the number of companies whose price-to-sales ratio is more than 10. And on the left-hand side, by market cap, the proportion of the market which companies with a price-to-sales ratio of more than 10 have. And as you see, when I started work, which was in 1977, there were really no companies which had price-to-sales ratios of more than 10. Then there were a few, and then there were a lot. By 2000, there were a huge number. We then went down to almost none again, and now we're at peaks, both in terms of market cap weighting and the number of companies, more or less. I think that is a pretty vivid illustration of how worrying the overvaluation of the US market is. This chart this chart shows the long-term outperformance the outperformance since 2008 of growth, and we're well acquainted with that. It's interesting that in the last few years, there's been a bit of a departure between the US and non-US markets. And there has to be a break. Either the light blue line has to fall or the dark blue line has to rise. It seems after this very long period more likely, and particularly because of this chart, that what happens is that the international outperformance of value, which has been around for the last sort of 3 or 4 years, is the trend which the US then takes to. This chart, too, I think you'll be very familiar with, the long-term outperformance of value versus growth, based on Farmer and French originally, and then by a study by 2 Centuries Investment, which incorporated these 2 other studies by Mr. Gertzman and Cowles. So it's a very long history in which value has had an advantage. And we've now had not only the longest period since the beginning of this chart, 1826, not only the longest period in which value has not outperformed growth, but also the sharpest degree of underperformance by value. And of course, there's only one history. The future can be very different from that one history. But it seems likely from this that we are at the edges of a golden period for value investing. And that has been part of the reason why I have, having retired a few years ago, decided to come back to work, and only 2 days a week, but in the last 2 years. And the state of markets means that it is possible to have a portfolio of perfectly sound companies at moderate valuations, even when so many markets and so many corners of markets are expensive. This chart shows the price-earnings ratios of the various bits of markets. US growth, US value, international growth, international value, and then our own portfolios. The P's are high of most of those areas. The P of our portfolio is around 13, which is the same as the international value index. And as you see from our blue line, which is the bottom line there, we're not paying any more of a premium to valuation than we have been at any time in history. We're roughly the same level of valuation that we have always been. And this just gives you an idea of what we do. We look for companies with low valuations. We run very concentrated portfolios, 20 to 30 stocks. I take the point that Janko made earlier about diversification, but if you aim to diversify with a 20-stock portfolio, you can diversify. I think the studies show that every addition after about the 15th stock, if you've aimed at diversification, does very little in terms of lowering risk. We are very long-term. We have an average holding period of around 6 years. We are utterly value-focused. So low P's compared with market, low price to book. We don't sacrifice much in terms of return on equity, and we very much dislike the combination of high financial leverage and high operating leverage in the same company. And so we tend to have a much lower net debt to EBITDA ratio than the average. And now turning to stocks, and I'm going to dodge any questions on stocks because, as I say, I'm a 2-day-a-week guy, but if you've got questions, then send me an email and we'll get you an answer. I'll briefly talk about two, Jardine Matheson and ArcelorMittal. Both of these are family businesses, which has been a bit of a theme this morning, and they very often are a theme in our portfolios because of the alignment of interest you get and the long-term ethos that you have in those companies. I loved the motto of Saga, which I hadn't heard before, "We do things properly." And I think you could contrast that with the motto of the private equity industry, which is "We do things improperly." Anyway, there are great advantages, I think, in investment in family companies. Apart from their family background, of course, Jardine Matheson and Arcelor are very different companies. Jardine Matheson is a conglomerate which has been around for a very long time. It's been around for 200 years with businesses in Asia, in cars, in property, in retail, in China, in Hong Kong, in Southeast Asia, mainly through 4 listed subsidiaries, which are Jardine Cycle and Carriage, the very name of which gives some sort of notion of the antiquity of the company, because it isn't really very much to do with either cycles or carriages now, which in turn owns another conglomerate, Astra, in Indonesia, Hong Kong Land, Dairy Farm International, which is a retailer, and Mandarin Oriental, which is hotels. And this has been a pretty fuddy-duddy sort of company. It's long been regarded as the kind of poor relation of its main competitive family business, Swire, and it has been very old-fashioned in management. I remember going in May '97 to lunch at Jardine Fleming, which was the Fleming subsidiary which Jardine Matheson then owned, I think, 50% of, in Hong Kong. That was a month before Hong Kong was handed over. And we sat at a lovely mahogany table, lovely Chippendale chairs all around the place, and portraits of the sort of the Jardine family, the Keswick family on the wall. And I thought, gosh, they just haven't, they're out of it. They're just not with it. This is not going to be good. Well, they did, in fact, better than I might have expected. They no longer own the Fleming subsidiary. But it has changed completely from that rather old-fashioned style. They do have a head office in London, the main purpose of which was it was only an office for the directors, who are London-based. And there were directors and then a team of butlers and cooks, and the purpose of that office is lunch. And one of the mottos of Sir Henry Keswick, who was chief executive for a long time and died last year, typically, sweepingly, was never invest in a country which has green in the flag. So that was the sort of company that it was. The company's chief executive is now Ben Keswick, who is a much more modern figure, and he has stepped up the pace. He's I think, a little akin to Jackie Elkan at Exor. He's announced a different management philosophy. Head office no longer runs an executive training program and sends out young British officers to run the empire, but instead oversees a portfolio of investments in each of which there is local autonomy. Nearly all, I think all the chief executives of the listed subsidiaries have changed since 2023, and people now at the junior level, they join a local company rather than having this sort of officer-like graduate training scheme. It is now much more like Fairfax of Canada, for example. And this is what this is the core of the point. The discount is well below the level that it was at between 2016 and 2021. The shares have done well in the last year. Net assets, as you see from the lines, have started to grow significantly, but the discount is still, and after the last 2 weeks, it's more than this. The discount is still around 33%, compared with an average in the 10 years up to 2021 of around 15%. So we think there's a lot of mileage in the net assets, and there's a lot of mileage in the discount to narrow. ArcelorMittal is a family business. 3 Mittals on the board, the chairman, the chief executive, and a non-exec. And it is a reformed business in lots of ways. It's exited the US. It has invested heavily in India. The production in India will go from 40 million tons, will go to 40 million tons or so by the end of the decade. And the whole company produces around 55, 60 million tons of steel now, so that gives you an idea of scale. They've also reformed the balance sheet, and this chart shows the debt, which has come down from around 18, 19 billion 10 years ago, and more than 10 years ago, it was more than that even, to a level of about 8 billion now. And they have got rid of their pension deficit. So they now have substantial free cash flow. They have a policy of devoting half of their free cash flow to buybacks. If you've got a 50% return proposition, then I would agree that the buybacks are not such a great idea. But if you have excess free cash flow, and the return, therefore, on any marginal capital investment you make is going to be low, then we are very strongly in favour of buybacks. They are more or less self-sufficient in iron ore, well, not far off self-sufficiency in iron ore, and they have a very expanding iron ore operation in Liberia, which will go from 10 million tons to 20 million tons over the next couple of years. And they're a beneficiary of tariffs, and also of the sort of tariff derivative in Europe, the cross-border adjustment mechanism. So their current margin is roughly $150 per ton of steel, and it's rising. And on the PE, on the current PE, as you see, it's about 10 times. We had, in fact, reduced. We had asked law for about a year and a half. We'd reduced and done something very uncharacteristic. It's fallen very sharply in the last 10 days, and we bought it back after a short time. We're not traders. It's very unusual for us to move in and out of a stock and back again so quickly. So those are the two stocks that I was going to talk about. I'll just mention one more, and that is really a sort of lament at the passing of Schroders, another family business, a UK family business, where the chief executive happens to be called Richard Oldfield. And I get quite a lot of sort of correspondence which is intended for him. Sold for $9.9 billion to Nuveen in the States. And I think this is a terrible matter for regret. Schroders had a very strong, long-term family ethos. I remember talking to Bruno Schroeder about this, who was the sort of patriarch of the family 10 or so, no, more than that, 20 years or so ago. I don't think he would be at all pleased at this sale. As my namesake said, nostalgia is not a strategy, fair enough, but a family business of that sort does have a particular strength, and I happen to think it is drastically mistimed, because one of the things that Schroders stands for is active management as opposed to passive, and it's also closer to the value end of investing than any other end. And those are two things for which I'm expecting a golden age to be beginning. Thank you.
Thank you. Thank you so much. Any questions? No? Seems people are hungry. Okay,
Thanks very much.
Thank you so much, Richard.